this theme forward of risk and reward. Deepak, let me bring you in to understand the risks and rewards associated with investing in, say, ETFs and index funds. And in your opinion, how young investors can effectively incorporate these into their portfolios?
So, when you're looking at the risk and rewards of investing in index funds, I think that's a fairly generalized umbrella. Now, when you look at index funds as well, over time, there has been a fair degree of nuance that has set in. But let's start with the most classic ones, which are your broad based vanilla indices like your NSEs, Nifty, or your BSEs, Sensex, which you've all grown up hearing about. Now, when you're looking at these broad based market cap indices, what you're really talking about when you're looking at investing in these index linked products is investing in India's growth story driven by, let's say, in particular in these two, the large cap sector. So it is about as broad based or as unbiased or as agnostic a view as you can take. So classically, some of these indices are your shut and forget options that you can sign up ideally via an SIP kind of a setup from a young age and keep deploying some of your capital towards the towards, let's say, the companies which can be simply considered as the growth engine of the country and are sitting atop the food chain in a manner of speaking. And given classical index investing used to be market cap driven, you are largely mitigating the risk of selection as you are kind of participate. You're basically encouraging participation versus selection. And I think that is the core idea of, let's say, passive investing, at least in its most basic or vanilla version. But I think over time, with investor appetite, with, let's say, the younger generation learning more about financial freedom and goals such as FIRE, as you had mentioned before, I think there is an appetite that people have towards, finding a financial advisor, setting their goals, let's say, figuring out or, evolving those goals over time as well. And that's where, to a degree, some of your more nuanced index funds also come into play, where you can take a more, let's say, a more holistic view than a purely market cap driven view. And to kind of take that idea further is, in fact, where ETFs come into the picture. ETFs give into your hands the control, which to a degree has never been the case when you're looking at mutual funds. And with great power comes great responsibility. So it's one of those classical things that, yes, while the control is given in your hands to a degree with ETFs because you end up trading them on an exchange versus, let's say, going to an advisor explicitly, you can firstly trade them intraday. You have the ability to trade them in an account versus subscribing into them. So they are largely enabling control. And to a degree, this is a concept that got really popular in the US, where ETFs became a dominant kind of a investment vehicle for investors, investor ages across the board, in fact. And that transition didn't necessarily happen because of this ability to trade them intraday, but it more so happened because people naturally prefer price discovery. Even if you don't want to trade them over the course of the day, having the ability to know what the price is, on a day like election, having the ability to see how your portfolio is really doing over the course of the day, gives people that sense of transparency. When you're investing your life savings, to a degree, transparency is a heightened element that you want. You don't necessarily want to action it. You've learned, let's say, over the years or through your own reading that touching markets when they're volatile is comes with its own risks and challenges. But having that ability has naturally led to the adoption of ETFs across the board. And
Hmm.
when you're looking at financial advisors in particular, and as people go up the strata of income streams, having an advisor who is able to work with your, let's say, set goals, who's able to take on some of the risk of entering and exiting these volatile markets with you, and who's able to advise you, that's when really ETFs enable you further
Hmm.
in terms of taking more focused bets as you are moving in and out of your investment journey to a degree. So while most ETF investors globally do not churn their portfolios intraday, but the very nature of ETF gives you that control. And
Hmm.
and as somebody rightly said, exercising control is the second step to first having it and appreciating it. And I think having it and appreciating it is what is leading to the growing adoption of ETFs naturally on the passive or to a degree of index linked products. But when I look
Hmm.
at the broader world outside the US today, ETFs or this intraday kind of flexibility is making its way into active or focused mutual funds as well, with active ETFs getting launched to a degree. So I think post pandemic in particular, we've seen a jump across the board in investor appetite in terms of handholding some of that risk a bit more closely. And ETFs are that path to encouraging a more sensible view of allowing investors to handhold that risk versus trading single securities or single scripts and getting
Hmm.
into even more risk, or for that matter getting involved in the future and the option market, where you naturally end up taking a lot more leverage as well. So ETFs are, let's say,
Absolutely.
somewhere in between that risk metric of sitting on your investments and looking to actively engage with them.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।